the report on AT&T, which we shared with everybody, which is our first what we call integrated human governance report, and arose as a consequence of commencing the ratings work together with Harvard Law School, which will rate the S&P 500 firms. And we looked at AT&T as an early one of the early companies which we've now rated, and produced that report essentially to start the process of understanding how this would pan out, and to engage the wider team in one of the outcomes. What that report does is a number of things. Firstly, it builds on work that we've done through OMS, and we produce a number of company research reports. And this is really an evolution of that research report. And what it does is both simplify, but also crystallize the key indicators as we see them in terms of how human governance and human capital management connects to value and risk within that particular company. Perhaps more importantly, I guess, and we see this as an important milestone in terms of the evolution of both the Maturity Institute and the human governance work, is that we've integrated financial analysis into that research note. And Nick Shepherd has done some fantastic work in looking at the numbers and seeing how they apply in a human governance and human capital management context, which was fantastically exciting for us, but also both validates and also enhances the nature of the analysis. And just to say before we go into that, that particular note has already opened doors with a number of very important global bodies, which we're excited to start a dialogue with, in terms of how we properly integrate human governance into particularly the accounting world. So that will be agenda number one. And then we're then going to go through what we've developed as a human governance scorecard. Again, I've shared this with all participants, and I'll talk a little bit more about that. But that's both a kind of a simplification, but also a broadening of bringing the ratings work to life against a number of critical indicators in a visual form. And then lastly, we'll go through our what we call our OM30+ methodology, which is essentially a question set for how we go about rating organizations. And we'll go through some of those questions to provide a glimpse of how we both do that externally, also how we go about doing that with a C-suite exec, so enabling an organization to essentially rate themselves, and also for steering group members really to understand that this is something which they can learn, and is an important component part of how to start on the journey of building human governance capability and knowledge in-house. So they're the three agenda items. So without further ado, I'll hand over to Paul and Nick. So Paul, do you want to start?
Yeah, sure. Thanks, Stu. Hopefully those who are logged into the call sitting in front of a computer screen will now have on their screen the AT&T report. Just a few words on the genesis of this report before we go into any detail on it. I think the first thing to say is that one of the key issues I think that all corporations are facing at the moment is being held to account more, or at least we're trying to hold them to account more. And at the root of that has to be how they report on what they're doing, why they're doing it, how well they're doing. So the whole question of corporate reporting is now a major agenda item. And when we started doing maturity analysis, that was one of our key objectives, is to provide a much bigger, better, richer, deeper, more insightful picture of what's going on in organizations by providing a more comprehensive report. And that's very much what maturity analysis is all about. When we started to do this sort of work, it led Harvard Law School to contact us at the beginning of this year. And they said, this is very interesting. We'd like to know more about what you're doing. Excuse me. And we started to work with the Harvard Law School guys. And to cut a relatively long story short, we actually took them through the Maturity Institute orientation to explain the methodology that sits behind these sorts of reports. And when we take them through the orientation, and the reason they were working with us is we are planning to do, in conjunction with Harvard Law School, a complete rating of the whole of the S&P 500 using this maturity analysis rating methodology. But at the end of the orientation, the two guys from Harvard said to us, so, give us a full insight to one of the companies on the S&P 500 so we know exactly what we're going to produce in terms of the S&P 500 index. And we said, okay, well, do you want to give us a company that we can look at? And they chose AT&T. So that's the genesis of this particular copy of this report. But actually, it's the first time, as far as we know, that anybody actually tried to produce what we would call a totally integrated report. So by integration, and I'll introduce Nick to take this forward in a moment or so, but anybody who knows anything about the accounting profession's issues with integrated reporting will know that there is an international framework now that includes things like intellectual capital, social capital, human capital, which is not actually captured at all in normal conventional reporting. So we decided that we would capture all of that from an integrated point of view, but we needed the expertise and the skills and the insights of a very well-trained accountant who was not just an accountant, but one that actually always had an interest in what I might call the people dimension of organizations. So this was the very, very first attempt to incorporate the human side with the financial side, if I can put it that way. So I'm going to hand over to Nick now, because Nick was instrumental in turning what was going to be a human capital report, if you like, but made it into a complete report by making sure it totally blends with the financial analysis of what's going on at AT&T. So, Nick, can I hand over to you?
Great, thanks, Paul. Hi, everybody. Obviously, we can't go through in great depth because there was the report that you actually saw a copy of is, in fact, a summary of a fairly detailed analysis we did with a lot more ratios and connections and linkages. My interest has always been in trying to get behind the numbers. I think, as Paul said, there's the whole movement around greater transparency, getting greater awareness of what organizations are doing, greater accountability. But I think you've got to put this in the context that one of the challenges that I and a number of members in the profession, unfortunately not a large enough number yet, I don't think, recognize that if you look at the financial information, in particular the three financial statements, but also the management discussion and analysis, and to a degree the documentation that, for example, is filed with the SEC in the US, the core financial information certainly, as we know, tells you historical information. And in a lot of cases, in terms of risk assessment and being able to determine that the health of the financials really doesn't tell you a great deal about what's going on behind the numbers. And AT&T was a really good example, because AT&T is an organization that's in massive transition. If you look at the global phone business, I mean, you can look at British Telecom, you can look at AT&T, you can look at Bell Canada here in Canada. All of these organizations came out of landline organizations and essentially are still in that business, but are trying to make the transition to not only both a landline and a wireless business, but also broadly a media delivery business. And this is a massive shift from a capital-intensive business to a people-intensive business and content-intensive business. And so what I set out to try and do in this sort of experimental report, and as Paul says, we are learning the process as we go, is to try and do two things. The first is, well, three things, I guess. The first is to go and have a look at what the financial analysts have already done in terms of looking at the financial performance of AT&T. And as most of you know, there's some really, really good information out there in terms of tearing the financials apart. But what I was interested in looking at is how does that relate to how they're using the various different assets, and in particular, human capital, but also relationship capital, manufactured capital, what they're doing behind the scenes to drive the future sustainability of earnings and cash flow and generally health of the business. And we can start by saying, all right, from that initial financial information, so that was my first part of the research, we also know that typically the marketplace knows that financial information doesn't provide the whole story. If we look at most organizations today, and the various studies that have been done will show you, I think the most recent number is that an average of 19% of an organization's worth in the marketplace, so its value attributed to it by shareholders and other buyers of the organization, including in mergers and acquisitions. The 81% is composed of other stuff that ends up on the balance sheet of the acquiring company as goodwill. And really that more and more in a knowledge economy is what goes to drive the numbers. So the second thing after looking at the financial information was to go and look, what sort of bridge do we have that exists between the existing financial information, so the traditional financials, and what the marketplace is saying that they believe the earnings stream of that company is worth. What's it worth from an investor point of view? What am I prepared to pay for it? Because as we start to look into that, we get some idea as the degree to which the marketplace has looked at the company and said, wow, this company is worth either no more than what is on its balance sheet, or it's worth significantly more than it's on its balance sheet. And in cases where we're talking about high technology companies, for example, or pharma, or people that use a great deal of human capital, that multiplier is significant. So we started having a look at this, and we tried to start correlating other filing information. Now that may include filing information with the SEC or other bodies, but also looking at other information like the company's website on corporate social responsibility, the company's website in AT&T's case on R&D, doing Google searches on financial settlements, union settlements, looking for statements that have been made by the CEO that give you some idea of strategically where the company's going, looking at the company's own website to see the degree to which that they have recognized there are risks associated with the transition that they're going through into human capital. It's very interesting in AT&T's case because they've just gone through this massive acquisition of DirecTV. And all of us know that an acquisition is something significant to digest for a company. And what's interesting, they talk about the ability to save $1 billion, I think it was $1.5 billion, or maybe it was 2.5, I can't remember off the top of my head, but a significant number of expenses being saved as a result of the acquisition and integration. But there is nowhere in the report that they talk about the risks associated with realizing those savings in terms of the impact it'll have on the human capital of the organization. And we know that in mergers and acquisitions, there's a significant risk when you put two organizations together that in fact you lose some of your talented people, and essentially what happens is you can see a significant drop in motivation just at a time when the company is trying to shift towards a more human capital oriented company. So first part of the exercise is to go and look at the traditional financials. The second is to look at what the marketplace in terms of investors has already said about the company in terms of the gap between true value and the traditional financials. And the third piece is to do all that research that then starts to look at, well, what really is behind the numbers? How much alignment is there here between what the organization strategically needs to do as part of this shift and what it actually appears to recognize it needs to do? So that really was the exercise. It's a task to try and, through research, to go and look behind the numbers and look at the consistency and alignment with what's actually going on in the organization, and the degree to which that provides assurance or risk that the organization, in fact, is going to be able to come through that transition. And again, one of the other things is to look at organizations like AT&T, where it's particularly interesting, where they already put a large amount of money into both their dividend and capital investment. They don't have a lot of room to move in terms of seeing significant changes in earnings. And so I would say, you know, from a risk management point of view, they're walking a tightrope. So what we're trying to do is to say, you know what, from an investor's point of view, Standard & Poor's and Moody's look at its balance sheet and say, yes, there's a bit more risk here because of the acquisition. But we're looking at it and saying it's not just the risk of the acquisition. You can see on the chart that's in front of you, what we've done is we've actually combined what Moody's and S&P say on the right-hand side of the chart, which is, you know, these guys are in pretty good shape, BBB rating type of thing, whereas the OMR rating is much lower on the chart. And we're really saying that, look, this is beginning to present to you a window of risk and a window of opportunity, because we think from a human capital point of view, this organization has a significant risk that it isn't actually recognizing. If you look at its financials, there's nothing in there that even has been identified as part of its risk going forward related to human capital. And S&P and Moody's probably isn't paying a lot of attention to that. So this tool is designed to really provide a little greater transparency and insight for investors into where the risks are. So rather than sort of go into any more detail, I kind of leave it at that, Paul. I don't know whether you want me to go anywhere else or add anything else. As I mentioned, there is, I forget what the number was, Paul. It's about a 12-page report, I think, behind this one, isn't it? That has all the analytics and everything.
I was going to, I'll tell you one thing I'd like to focus on very briefly, Nick, if I could just scroll down here. If people can see those who've got a screen, under our total value review, we've got a heading here called Value, Strategy and Human Governance, because the human governance issues are paramount these days, and we can talk about some of the issues there later on. But it's an absolutely declared policy. So it's a declared policy that shareholders are afforded primacy at AT&T. And for an organization that now employs 280,000 people, to actually be publicly saying to any employee who wants to read their website or look at their annual report, that the people we put first in this organization are shareholders, sends a very interesting signal to such a huge workforce. And I think this report that's the starting point, I think, for our analysis, which is, you know, who comes first in the eyes of the board and the directors of companies like AT&T, huge companies with huge issues to deal with. And regardless of whether they regard shareholders as their main stakeholders, I think every company accepts these days that they're meant to manage all the stakeholders and not just one group. And I think one of the key issues that comes out in these integrated reports is the extent to which a board and the executive team have a coherent view on how to manage everybody's expectations and to ensure that, particularly from an employee human capital point of view, that if they are expecting to get the best returns and the best value out of people, you know, if I was an employee of AT&T, I'd be asking myself the question, well, if shareholders come first, what's in it for me and how much commitment do I have to give to this organization. But yes, Nick, going back to what you were saying earlier, if I just scroll down, this actual report is 5 pages long. That doesn't mean it covers everything in every bit of detail, but it gives you an idea of the sort of areas that we look at, the width and breadth of it, some of the concepts that underpin it, like the shareholder primacy idea. Here we have whole system thinking and management. Maturity analysis always tries to capture a picture of the whole system and sees the organization as a whole system. And Nick and I and Stuart will all attest to the fact that writing a whole system view of an organization is something new, and it is not easy. It requires a lot of skill, a lot of analytical insight to pull together what on paper might look like very disparate aspects of a business. For example, just below there, it's got R&D. Most organizations are still treated really as silos with different functions and different departments. And one of the key differences between an integrated report and a standard or conventional company report is pulling all these different aspects of the business together to get a complete overview of what's going on in it.
Can I just add a couple of things, Paul?
Yeah.
Back to that first one that you were focusing on in terms of the primacy of the shareholder, I think there's a couple of points here to make to people.
Okay.
The first is it really is a reinforcement of what I would call traditional management thinking relative to human resources, because it really says I see human resources as a cost, not as an asset in running the business. There is no question, and I think this is sort of shades of gray, that there's no question that they have to keep their eye on continuing to satisfy the investor. But we all know that that is an outcome at the end of the day from optimizing the other resources that they utilize in the business. And that's the second point here, that if we look at something like the integrated reporting framework, one of the concerns that I think Stuart and Paul and I have is that the work of the IIRC in the integrated reporting framework provides us a nice sort of, if I can sort of put it in building terms, it provides us a nice scaffolding around the building, because it talks about the 6 different capitals that the board and management should be concerned about, managing and optimizing all of them to the long-term sustainability of the business. But in this particular case, we can see that AT&T appears to be fairly traditional in the way that it approaches its view of the various different groups of resources, i.e. the capitals that it employs in the business. So it's not in any way trying to discount or reduce the importance of the shareholder and the investor, but it's really saying that, look, as a board and a management team, if you're going to sustain these outcomes for the shareholders, and they talk a lot in their annual report about the importance of increasing the dividend every year, etc. If I was a shareholder, I'd be saying, yes, but I want to look at what actually is going on behind those numbers, and how are you employing your sort of intangible assets in the organization? Are you depleting those to generate these earnings? Are you in fact enhancing those to generate these earnings? So even though it's a tiny little paragraph there that Paul has pointed out to you, it contains a lot of sort of background and messaging about the quality and sustainability of earnings into the future. The second piece is the R&D piece that Paul just talked about. Again, this provides us with an interesting bridge, because AT&T have a really great website that deals with their West Coast function that's set up to be R&D. And AT&T has a really good history. AT&T Labs has a significantly positive history of things that they've developed over the years. Unfortunately, we also know that some of the things they've developed, they weren't able to operationalize that effectively. But the point here is, I can look at how much you're spending on R&D as a percentage of revenue, and how much of your cash flow is going to R&D. And I can compare that to other companies in the industry, and that's an interesting number. But what I really want to know is what's coming out of this. To what degree is this actually coming up with things that can be operationalized? And if you go and look at their website that talks about the R&D that they do, it actually says, even though they're spending a ton of money, if you compare the number of sort of ideas and improvements that are coming out of this investment, it is pretty abysmal compared to sort of stellar organizations that have built continual improvement into their operations, like Toyota, obviously. So again, this is another example of how we're trying to build a bridge between the financials and what else does this tell us about the quality of what's behind those numbers. So having R&D is great. At the end of the day, it's to what degree is it actually being leveraged to build future capability you need to survive in the business.
Okay, Nick, thank you very much. Stu, do you want to pick it up from there?
Yeah, no, that's great. I mean, I think you guys have done a fantastic overview in terms of what the AT&T report is set out to accomplish, and hopefully people have got a very good sense of that. You'll get a sense that we don't rate AT&T that highly on our rating scale, and I think one of the things Nick and Paul have mentioned is actually when you start to look and you start to understand the dynamics from a human governance perspective, we can pick those things up very, very, very quickly. It was very obvious that AT&T manage all the people within their organization, all their human capital as a source of cost and not as a source of value. So already they're on the left-hand side of our ratings scale, simply because they're not managing people from a value perspective. I think we were also a little bit surprised at how poor the organization truly was in that respect. And I found, and there were a couple of very interesting indications around those. One was a big message to the media from the CEO that the sort of 280,000 people within their organization didn't have the requisite skills to be able to help the firm compete with the likes of Apple and Amazon and certainly the various tech players in the market. And I thought that was an astonishingly big statement to make. Yet, as Nick said, there was no analysis of the risk of that attached to any number. And also the response of the organization to that was to provide actually mandate everybody in the organization to go on online training, which is a bit like, if that's really the issue, it's a bit like, sticky plaster to a gaping wound. And so, very quickly we can see that AT&T, is carrying both risk, but also the value implications for the organization is significant. And that's the piece from an investor perspective, and that's a piece for the board of AT&T. And as we do all these pieces of work, we make every effort to contact the company to ask for their to participate and provide feedback, because we'd like to engage with boards. That's the whole reason MI exists, is to put these issues on the table and to really say, look, you're missing a huge piece of value for all stakeholders, and this should be looked at. So that's pretty much all I wanted to say on the AT&T report. So thanks very much for that. We'll move on. I think we don't have any chats. If anybody has got any questions, you can fire them in. I did get. I've got a couple of questions which I'll share, which is who audits AT&T and what response have they provided. We haven't contacted the auditors, so maybe we should. And certainly, I mean, the interesting thing for us was to use this to validate our methodology and with the guys at Harvard, and I think in doing this exercise, it's certainly shown the power of the rating. And I think when we move on to item 2, we can start to see that when we rate an organization, not only can we produce in-depth analysis at company and sector level, we can start to do other things with the data set. So Paul, if you want to throw up the scorecard, the human governance scorecard, we can talk a little bit about that, I think. you able to do that? Okay. Okay, so hopefully you've got on your screen, which is what I've got, which is a human governance scorecard, I talk a little bit about the gestation to this, and I'll give a quick overview of the scorecard. We were introduced to an organisation in California who are a big ESG advisory organisation, and we were talking about potential ways we could collaborate, and one of the things that was brought to our attention was something that the White House had publicized, which was a list of firms which I think they purchase goods and services from, a big list of firms, and against those was a traffic light system around carbon disclosure. And the comment to us was, is there a way that you can visually show your rating and some of the key indicators that are rising out of how you measure human governance or get to an organizational maturity rating? And so we went away and thought about how we could visualize that data and what further analysis we could do of a rating which would yield some interesting insight. And so what we produced was what Paul has just shown on the screen, which is to take our rating, and as part of our ratings, our question set, there are a number of areas which we looked at and pulled together to create a kind of a sub-score or a sub-rating. And I'll mention I'll mention each one, but as you and go through it in a bit more detail. But we already had ratings on these companies, so we thought let's look at each of these ratings and see how they score against each of these core indicators, where we've got a number of questions that we can aggregate and distill a score against. And as you see, there's a traffic light scoring scheme just above that. So what we've got here, if we look at AT&T, we've got the human governance research report, and then we've broken the actual rating down into these component parts. So their overall rating is amber. So it's not a disaster, but it's not great either. But then if you start to go along the top axis, if you like, we measure societal values. So one of the things that we're looking for in organizations is an understanding, and not just an understanding, and an acknowledgement that actually providing value to society is the way to create long-term value for all stakeholders. So an organization just below that, Handelsbanken, is a great organization who understands and can reconcile that ultimately they should be serving society, and by serving society fantastically well through the best possible customer service and quality of what they do, they actually serve their local communities in the best possible way by being a fantastically financially stable organization, and by serving their community so well, they make enormous profit, and actually over 40 plus years they've been the most profitable bank in their comparator group. So there's an understanding that delivering societal value delivers value for all, and ultimately shareholders too. So that compares with AT&T, which puts shareholders first, and ultimately we believe is not actually delivering the kind of value it could be to shareholders, because it can't reconcile these two things. So societal value is something we measure and we can show in the form of a traffic light. Corporate purpose is the next one, and purpose is incredibly important. It's the first question that we ask of an organization. What is the purpose of this organization? Why is that important in a human governance context? Well, there's plenty of evidence that's been emerging over the last 5 years that purpose really, really matters in a very significant way. And if an organization has a clearly articulated purpose, it can essentially seek to align all its people to realize that purpose. It's as simple as that, really. But corporate purpose is something we want to score. Again, AT&T don't score well. Handelsbanken have a very clear corporate purpose, and coupled with an orientation to serving society and embedding that means that in value terms, the value creation is significantly more than their comparators. And we start to see that across organizations because we can do a comparative score. Human governance, there are a number of questions around that. So, to what extent is human governance truly recognized and managed within these organizations? It's very rare to find any organization that does that explicitly and does that well. And in fact, none of those organizations are green in that respect, and there's a lot of work to be done. It tends to fall to a CEO to take ownership of that. A good example would be Unilever, who have and you can see this on the public records, who had an issue with mercury poisoning in India, which has been running for around a decade, well over a decade. The allegation of mercury poison affected not only workers, but it affected people from the local community. And that's a nice example of true human governance. So you have an organization that allegedly is not just has got working practices or a working environment which is toxic to its workforce. It's actually causing damage to people outside of the organization. Now, no one was taking ownership of that issue until Paul Polman stepped in, primarily because of a YouTube video that went viral earlier this year, and finally the company settled the long-running sore, shall I say. And so this is why we see this as an absolutely critical issue, which is missing from the top of organizations. And I would probably suggest that there will be very, very few, if any, organizations that score green in that respect. As we go down, innovation, we measure. You'll see on the AT&T report that we have a clear measure of innovation. And the standard we have is if one person, if an organization has 100 employees, everybody comes up with one idea per year. That's 100%. And what we're starting to see is that organizations are starting on the edges to report against that. So AT&T actually do report to some extent innovation within their organization, as do Pfizer, but they don't get anywhere near as close as Toyota in terms of yielding the value and the scale and the extent and the actual significant value outcomes of that innovation. So we can measure innovation, and we do, and it's visually represented there. Realizing human value. Does the company truly connect human beings with value creation, and to what extent does it realize that value? Again, you'll see that there's a couple of reds. AT&T, Microsoft is an interesting one. We do not rate Microsoft highly in terms of its ability to realize value from its human capital. And that might sort of surprise some people because they're often seen as an employer of choice. In fact, they're often at the top of employer branding lists and great places to work. Actually, when you get under the skin of the Microsoft organization, its advantages are not, are not in the way that manage people within their business. And while they've been phenomenally successful, that value has not been realized from managing people well. And that's a very important distinction from an investment perspective, because you may well hold Microsoft because you like the technology, you like the competitive advantage that their products and services bring, and you think that they're there for the long term, and they'll generate a lot of great revenue and profits and keep building the huge cash pile. What we're saying here is that as an organization that could create even more value, but it's failing to do so even today, post Steve Ballmer under Nadella's CEO stewardship. So that's an interesting one. Supply chain health is another measure we look at. So human governance looks at the nature of supply chains, to what extent are supply chains managed as a source of value as opposed to a source of cost is the first thing. And you'll see in there that there are issues across a number of organizations, and there are very few organizations that really do manage their supply chains as a source of value in the organisations there. Toyota rate well, and Handelsbanken rate well in that respect. Business risk, what's the business risk arising from human governance? As a general comment, we do not find any organisations that understand this well. They do not assess and manage human risk within their organisations in a coherent and comprehensive way. But nevertheless, it's now increasingly recognised, typically under the idea of bad cultures cause harm and bring material risk to an organisation. We do not see organisations doing this very well. Hence, most organisations don't score too well here. In fact, what you find is that the assessment of human risk within the organisation tends to be fairly limited around talent attraction and retention. If you look at an organisation like Microsoft, supply chain, labour rights, and if you look at other organisations, and even an organisation like Nestle, while it's suggests it works very, very hard to try and make sure its supply chains don't have things like slavery arising, they're still being found to fail in that respect, hence the red according to Nestle. So the idea behind this is to break down the rating into component parts and to visually represent that so that people can see very clearly where these organizations sit. And it's something that we will build into our company reports, but more importantly, look to do this to underpin our own ratings when we build out our OM index. This is something we can build upon. I think the example of the White House and using the carbon disclosure is a very interesting one, because this is the kind of visual representation which is very easy to recognize and see, and also fundamentally what we want to do is to encourage and even force organizations to have a dialogue around these issues. Essentially, while this could be seen as kind of a naming and shaming, we're really not interested in that for its own sake. We want to engage with organizations and through the investment community to engage with organizations to actually focus on the value creation opportunities that exist within most of these organizations. So hopefully that provides an overview. Paul, I don't know whether you want to add anything to that. Are you there, Paul, or have you dropped off?
Can you hear me now?
Yeah, I can hear you now. Yeah,
okay.
Yeah.
Just a few quick pointers. As you said, we were sort of asked to produce these traffic lights, and I think there's a lot of data, statistics, analytics flying around in this space at the moment. And I think it's important to distinguish between the simplistic and the simple. Behind these simple traffic lights is a very sophisticated analysis, but a lot of simplistic data, and I'll take one from the HR community of training days per year. Some of these things look like numbers, they look like metrics, but they don't actually tell you anything, and there's not a lot of sophistication in the analysis that goes behind counting training days. So I think we'd like to promote the idea of simple representation of complex issues, and I think this traffic light system does that quite well. I think a couple of other points. We're actually gauging organizations not against conventional norms. An investment manager said to us at one of our earlier meetings about, most companies are mediocre. Well, they were mediocre until companies like Handelsbanken and Toyota came along and shook up the conventions and said, we can manage this organization significantly better than before. Then the mediocrity that's out there becomes less than mediocre. So we're actually assessing against potential returns, potential value that can be achieved, and that's a higher standard. But as Nick was suggesting earlier, a huge opportunity for the vast majority of companies, and the managements that rise to that challenge. That's the other thing that we're really assessing is management quality and capability. And all of that is captured in these simple traffic lights. All of that sits behind these simple traffic light schemes. That's all I wanted to say, Stu. So if you want to move on.
Yeah, no, that's great. So we'll move on from that. If anybody's got any questions, if they want to type a message, then please do so now. And I'll ask Paul just to load up the final screen share, which is not the full, well, isn't in fact our OM30 methodology as such, but is something we recently added to our website only last week. And just again, some context, we wrestle with the idea of sharing the underlying methodology with the outside world in terms of how we rate organizations. And, while we are obviously nervous about doing that in terms of allowing somebody to run away with it and copy it and do their own thing, we also want to build understanding about what we do, and to also show what we do, so people get a very, very good understanding, or at least how we go about what we do in terms of getting to grips with this notion of human governance. So what we've decided to do within the Maturity Institute 2-day introductory program, which we call our orientation, is to increasingly share that methodology and work through our question sets with people that come on the program. And we feel that that's the right thing to do in order to build understanding and share knowledge. And I think the other thing that we are increasingly understanding is even if people get the questions, even if people understand the methodology, this is a new management discipline, and it is complex. And in order to get to grips with it, takes a great deal of time and effort and energy. So actually, even when you see the questions, it's pretty difficult to get a sense of, okay, how am I going to use this to actually go and do this myself without certainly getting the support of the Institute. So what I'm going to do now is just quickly share some of the questions that we've reworked and actually positioned as if we were talking to a CEO, because they apply very directly to a CEO. And we'll start to build out, start to look at each of these questions, consider them from an OM index perspective in terms of what we ask, and use some of these questions also in terms of if we're working with a company and somebody at C-suite level, perhaps a CEO, how we go about that with an organization themselves. If you're interested, you can go on the website and have a look. We did this meaningfully for the first time only last month with a US law firm. I would say this, wouldn't I? But the response was absolutely phenomenal, in the sense that one of the things that is asked of us, not just okay, how do we go about rating an organization, but how do we bring it to life in the day-to-day practicalities of an organization? What we found in terms of going through this question set directly with an organization was we were able to take things from a very, very high level, talk about organizational purpose, all the way through to day-to-day management practices, which ought to be revisited if that organization was going to deal with some of the value opportunities and some of the risk issues that were inherent within that organization. So, Paul, I don't know if you've got that screen that you can put up again, which is the question set, and we'll go through one or two of those questions. Okay.
Okay.
Yeah, I've got it. So if you just go down a bit, Paul, and we'll start from the top. So, as I said, we've rephrased a number of questions, we've repositioned them, but I'll talk to some of the key concepts. The first one is authenticity, and we want to understand to what extent an organization is authentic in terms of how it presents itself to the outside world. We need to measure that. And from a CEO perspective, we're asking the question, am I authentic? Because the CEO needs to be authentic in order to be believed, in order to build trust with both internal and external stakeholders. So authenticity is critical in terms of how people within an organization relate to that organization and trust that organization, and therefore respond in terms of giving their all, bringing their 100% to the work table, if you like, and actually creating value for that organization. So that's our first question. The second question: what is the purpose of my organization? Well, we've mentioned this a few times, and this is the first. This is a really critical question in looking at the top 100 companies in the UK. Off the top of my head, I think there were about 6 that had a clearly articulated purpose, which I think is quite shocking, because you would expect most organizations to understand what their purpose is. And what we find is that there are very few publicly listed organizations that do have a clearly articulated purpose. So when we measure and rate an organization, we want to find a clearly articulated purpose. We then want to understand to what extent that's societal in dimension, and to what extent that purpose is embedded across the whole organization. So we have quite a sophisticated measure of purpose. And in fact, in our rating, it comprises about 6% of the total score. So if you score well, you can get 6% already on purpose. That's how important that question is. As we move down the list, what is the intrinsic value of this organization? Well, I mentioned Microsoft. If we look at Microsoft in terms of the intrinsic value, we would argue that value does not arise from how Microsoft manages its human capital. It arises from that the long-term value that's inherent within that organization comes from other things. And therefore, the question to the board is well, how much more value can you create by better managing your workforce and better managing all the people that are connected to your organization? Because if you do that, you'll get more competitive advantage, you'll become more sustainably valuable over time, and ultimately you'll differentiate yourself against others. And in fact, all the role models that you look at the top of our rating scale are organizational role models across, both within sectors and across sectors, which is interesting. Paul, if you want to move down, we'll pick up on a couple more. What are my core values, and do I live by clear principles? Values and principles, come straight off purpose, and these are building blocks of a strong and healthy culture. And one of the things, which was really something that we only realized relatively recently, we've been practicing for years and years. There's so much talk about corporate culture, but what we see very clearly is that human governance not just drives corporate culture. Actually, when you start to look at these questions and ask yourself, corporate culture emerges out of human governance. It arises. It's an outcome of human governance. And what we're doing is, and Nick, who was on the call earlier, as called it again, we're able to codify culture. We don't measure culture as such. We're measuring human governance. And if you score well in human governance, if you're a good organization in terms of if you're able to generate value from effective human governance, then you are likely to have a much healthier, stronger culture, which both realizes value and mitigates risk. I'll just mention one more. If you just go down, Paul, let's pick up. Paul's talked about 16. Do I understand the power of the whole system? Very few organizations understand their organizations as whole systems. One of the things that we talk about a lot in terms of who should be at the C-suite level are people that can think in whole systems terms, who understand how things connect with each other. And while none of us would put our hands up and say we might not be the greatest whole system thinkers in the world, at the end of the day, that's an incredibly important management practice. Is if I mess around with the executive reward, what's the impact of that on our whole organization? If I'm making headcount reductions today, what's the value outcomes across the whole organization? If I do something with our suppliers, what's the impact of that on other systems within our organization? it's the piece which really brings the human governance thing to life in terms of its complexity and sophistication. And so, for a CEO, do you really understand the power of the whole system? Is my organization working as a smooth and effective whole system? Hopefully that gives you a sense of some of the questions we ask. And as Paul scrolls down, there are 32 here. And all these questions derive from our underlying methodology, and which we use both to rate organizations externally and also use in terms of taking through these questions with people in-house. So, throwing this out to the people on the call and the people that are listening when they get the audio of this, we want to apply this methodology more and more. We are doing this on the S&P 500. We're going to build this out to across other indexes around the world. But actually, we also want to use this with organizations themselves. And actually, what we're finding is the more we use this in-house, the power of that is incredible in terms of how we see this being brought to life, the case studies that we can present, and also the value that we can bring to organizations directly. So from an investor perspective, if you're holding stock, this is a very, very powerful way of bringing a coherent whole system question set to the C-suite, which we can open up these issues very, very quickly. In fact, we did this in about 3 hours, 2 to 3 hours last month. So for us, we've gone from being able to do, thinking a couple of years ago, we thought we'd need 2 to 3 weeks to do a rating. And we're now doing it in 2 to 3 hours, which gives us fantastic ability to bring this to life in a very, very powerful and quick way, both at board and exco level, and also applying the methodology in a wider sense. So I'll finish there. Paul, did you want to say anything before we end today's session?
Just one final comment, really, especially as this is about human governance. I think when people see some of our low scores on human governance, and you said we're not here to name and shame. This is a new field. Integrated reporting in this way is a new field. The skills to do the job are new. We are all learning as we go. And so we wouldn't expect people to get high scores. So, if we manage expectations, then people won't see it as naming and shaming, but actually an opportunity to learn better ways of management at the end of the day.
Okay, great. Well, thank you very much for everybody being on the call. If you've got any follow-up questions, please let us know. More importantly, if you've got any ideas around how we can bring what we do to life through the Institute, wherever you work, wherever you live, or wherever you are around the world, we would love to hear from you. Our collaborations and our working groups are becoming bigger and wider, and we need to continue to do that. So if you've got any ideas or thoughts around that, please let us know. If you want to engage with the Institute more directly and come on one of our orientation programs, then please do. It's a phenomenal way of building understanding and starting the what we call the maturity journey, and being able to take that back to your own organization and start to encourage a dialogue around these issues. MI is here to help and support you all the way in that respect. So please let us know if you'd like to do that as well. Otherwise, we'll end the call here, and thank you very much. And I will follow up with an email to everybody and hope to see you again in the near future. Thank you.